These three ETFs are making investors insane returns right now, and nobody is talking about it. While everyone's chasing tech stocks and meme coins, these three ETFs are quietly crushing the market. Not with hype, not with hope, but with real performance backed by solid fundamentals. I'm not going to waste your time. This video isn't about gambling on the next moonshot or catching a falling knife. It's about identifying the unsexy, overlooked ETFs that are doing exactly what they're designed to do: print money quietly, efficiently, and repeatedly. If you watch to the end of this video, you'll discover the three ETFs that are quietly outperforming right now, why they're winning in today's economy, how to think like a strategic investor, and how to spot the next batch of silent ETF winners. Let's get started by redefining what it means to print money in investing and why most people miss these opportunities. At its core, an ETF is a financial vehicle that gives you instant exposure to a basket of investments: stocks, bonds, commodities, or sectors. They trade on the stock exchange just like individual stocks. But instead of betting on one company, you're spreading your risk across dozens or hundreds. And here's the key: some ETFs are built to mirror broad indexes like the S&P 500, but others are designed to target high-performance themes: dividends, energy, tech innovation, healthcare, infrastructure, you name it. The real game? Spotting the ones that have both tailwinds and traction. So what makes an ETF print money? No, they don't literally print cash, but they generate consistent income, capital appreciation, or both, even in a shaky market. That's rare. That's powerful. The three ETFs that are printing money right now. Let's break them down one by one, with deep analysis, numbers, and what makes each one special. ETF number 1, Schwab US Dividend Equity. ETF. Let's kick things off with a powerhouse that's quietly making investors wealthier every single month: the Schwab Dividend Equity ETF. Now here's why SCHD is a standout. It's currently delivering a dividend yield of around 3.5%, which means it pays you just for holding it. That's steady income, month after month, especially valuable in a high inflation or uncertain market like today's. But income alone isn't enough. What really makes SCHD shine is its ultra-low expense ratio of just 0.06%. Think about that. While many other funds slowly drain your returns with hidden fees, SCHD lets you keep almost every penny your money earns. You're not just earning a solid yield, you're keeping it. Put it together and what do you get? In the past year alone, SCHD has returned around 16%, combining dependable dividends with real capital appreciation. That's the kind of performance most investors dream about, especially from a fund focused on stability. If you had invested $10,000 into SCHD in 2015 and reinvested the dividends, by 2025 your position would be worth roughly $21,300. That's a 113% total return over 10 years, with significantly lower volatility than the S&P 500. Slow, steady, and tax efficient. SCHD doesn't chase hype. It holds high-quality U.S. companies with strong fundamentals, healthy balance sheets, and a history of growing their payouts. This ETF is built for one purpose: long-term, tax-efficient wealth creation. Why SCHD is a wealth-building machine? SCHD doesn't just chase dividend stocks. It targets companies with consistent dividend growth over 10 years, strong free cash flow and return on equity, and financial discipline. Top holdings as of 2025: Broadcom, AVGO, PepsiCo, PEP, Texas Instruments, TXN, Verizon, VZ, and Lockheed Martin, LMT. Performance story: from 2015 to 2025, SCHD has returned over 110% with dividends reinvested. That's nearly doubling your money in a decade, without gambling. Its strength is consistency. It doesn't soar and crash. It quietly compounds. Why it's printing money? Right now, in a rising rate environment, income becomes king. Schwab US Dividend Equity offers that. It holds profitable, cash-generating giants, many of which are less impacted by inflation. Institutions love it. Steady flows, safe reputation, easy to hold long-term. ETF number 2, Global X Uranium ETF URA. If SCHD is the steady engine of dividend income, then URA is the high-octane fuel of explosive growth. This is the Global X Uranium ETF, and it's one of the most overlooked winners of this cycle. In the past year alone, URA has delivered a return of roughly 38%, and it's not by accident. The world is waking up to a new energy reality. Countries are rapidly shifting away from fossil fuels, but renewables like solar and wind can't do it alone. That's where nuclear energy and uranium comes in, and URA gives you direct exposure to the companies powering that nuclear resurgence. Now here's the smart part. URA isn't just about growth. It's also a well-structured ETF with a reasonable expense ratio of 0.69%. That's a fair trade-off when you consider the potential upside and the global demand shift that's pushing this entire sector upward. This ETF holds a basket of top-tier uranium miners and nuclear energy firms like Cameco, NextGen Energy, and Kazatomprom. These aren't speculative startups. These are legitimate producers sitting on strategic resources that the world desperately needs. And as uranium prices climb and governments double down on nuclear investments, URA continues to benefit. It's volatile, yes, but it's also strategically positioned in one of the few sectors with both political support and economic necessity. This isn't just growth. It's growth backed by policy, by demand, and by global urgency. Why URA is surging, global energy policy is shifting, governments are under pressure to reduce carbon emissions, maintain stable baseload power, diversifying away from oil and gas dependency and nuclear energy is stepping back into the spotlight. Risk factor. URA is volatile. It's resource-based, politically influenced, and tied to global sentiment. But the upside is huge when the stars align, and right now they are. URA was trading under $14 just 18 months ago. It's now closing in on $20 plus. A 40% move, and it may not be done yet. If you invested $5,000 into URA in 2023 at around $14 per share, that stake would now be worth over $7,000, a 40% gain in just over 3 years a year. Now scale that to $25,000 and you're talking about over $10,000 in profit from just one macro-driven conviction play. ETF number 3, S&P. Biotech ETF X BI. Last but not least, let's talk about real life-changing innovation. And there's no better ETF for that than XBI, the SPDRS and P Biotech ETF. This fund doesn't just track big pharma. It's focused on early and mid-stage biotech companies, the ones developing the next generation of medical breakthroughs, from gene editing to mRNA vaccines to AI-driven drug discovery. XBI got crushed, down over 45% from its 2021 highs. But smart investors saw the opportunity during peak biotech pessimism. From 2023 to 2025, it rebounded over 20%, and it's still gaining steam as gene editing, immunotherapy, and AI-driven treatments move from labs to the real world. What makes XBI especially powerful is its equal-weighted structure. That means small, innovative companies get just as much representation in the portfolio as larger ones. So when one of these companies hits a breakthrough, like FDA approval or a successful trial, the impact on your returns is meaningful. And the best part? Despite its high growth focus, XBI keeps its expense ratio at just 0.35%. That's incredibly efficient for a fund with access to such specialized high upside assets. You're not just investing in biotech, you're investing in the future of medicine. And with AI, automation, and personalized healthcare pushing the boundaries of what's possible. This sector is entering a golden age. Yes, it's a bit more volatile. But that's the trade-off for upside. And with a diversified basket like XBI, you're spreading risk across dozens of biotech innovators, not betting the farm on just one. If you want exposure to massive innovation without trying to pick the next unicorn yourself, XBI is your launchpad. What makes XBI unique? Unlike other ETFs that overweight large cap players, XBI gives equal weight to emerging biotech firms. That means the gains are not to see dominated by just 2 to 3 companies. Top rotating holdings, second quarter 2025. Therapeutics, CRSP. Alnylam Pharmaceuticals, ALNY. Intellia Therapeutics, NTLA. And Sarepta Therapeutics, SRPT. Why biotech is the best option. AI-powered drug discovery is cutting costs and timelines. Gene editing is entering clinical application. M&A activity is heating up, with big pharma acquiring smaller innovators. The post-pandemic correction created value-priced opportunities. Hidden advantage, XBI offers exposure to moonshot innovations without requiring you to pick the winner. One company may flop, another may double. The ETF smooths that ride. Biotech is volatile. FDA decisions can tank or rocket a stock overnight. But in ETF form, the risk is diversified. So now you know the 3 ETFs that are quietly crushing the market. SCHD, URA, and XBI. But let's flip the question. How do you find the next ETFs that are about to start printing money? Here's your step-by-step blueprint to stay ahead of the curve. Strategy 1. Track long-term macro trends. Every ETF that outperforms isn't just lucky. It's riding a massive wave of momentum that was set in motion long before the price started to move. For example, SCHD tapped into the rising demand for income as boomers retire and capital preservation becomes a priority. URA is being powered by the global nuclear energy revival, fueled by climate policies, energy security concerns, and government incentives. XBI is gaining momentum thanks to biotech breakthroughs, AI-driven drug discovery, and massive health sector innovation. So here's what to ask yourself. What industries are getting government funding? What are the top CEOs talking about in earnings calls? And what's being debated in regulatory circles? When big macro forces and capital start to align, ETFs positioned in those sectors start to surge, and that's your window. Strategy 2. Follow the smart money strategy. Forget chasing Reddit hype or viral YouTube stocks. The big money and the smart money moves quietly and methodically. Institutional investors don't gamble. They allocate based on long-term themes. So where are they putting their money? Use tools like ETF.com. Morningstar and BlackRock's quarterly flow reports. These platforms show you where billions are flowing, and when you start to see consistent inflows into a particular ETF across multiple quarters, it's time to dig deeper. Follow the flows, not the noise. Strategy 3. Study the holdings, not just the name. Just because an ETF has a shiny theme doesn't mean it's a quality investment. You need to pop the hood. Ask yourself, are these companies profitable or pre-revenue? Are they innovators or just riding buzzwords? And are the valuations reasonable, or are they already priced for perfection? URA is a great example. It holds real uranium producers like Cameco, not just speculative exploration firms. SCHD focuses on dividend growers with strong fundamentals, not companies that used to pay dividends but have been cutting them. Strategy 5. Dollar cost average into volatility. Some ETFs, like URA and XBI, are volatile by nature. And that's okay. The smart move? Don't throw all your capital in at once. Use a dollar cost averaging approach. Spread your entry over weeks or months. That way, if prices dip, you lower your average cost. If they rise, you're already building gains. Volatility becomes your ally, not your enemy. Let's summarize. SCHD is the quiet dividend king, compounding cash year after year. URA is the high-conviction energy play, powering up on global demand. XBI is the innovation machine, rebounding fast with next-gen medicine. These aren't hype plays, they're strategic assets, they're compounding vehicles, and they're printing money, quietly, efficiently, and under the radar. You're not here to chase trends, you're here to win quietly and strategically. Drop a comment. Which of these ETFs are you most interested in? And go. Watch the video above where I explained in detail how to survive a recession the only proven way.